Hello, today we're going to be talking about company accounts. Every company has to, by law, prepare accounts, and it can be just for that compliance thing. But what we're going to hopefully do today is help you understand accounts and think about the transactions that all businesses undertake and what the impact is to their financial position. So we've drawn up here very simple a profit and loss account. Profit and loss account, I think most people understand those. You have income, sales, the cost of sales gives you a gross profit, less the overheads or running costs of the business gives you the net profit. The taxman takes his bit, gives you your profit after tax. You then pay dividends out to the shareholders and the profit that you retain for the year. So the profit and loss account, very simple, and that is measuring what's happened up until today. So it's from a point from day one through to your first set of accounts, and then the new start of the new year through to the end of that year. So a profit and loss account is looking at the transactions over a period. The other part of accounts is the balance sheet. Not everybody is as au fait with what a balance sheet looks like, but it's really a summary of the assets and liabilities. So the traditional approach is you have fixed assets to begin with, so that'll be equipment, cars, machinery, that sort of thing. The current assets, so the stock you're buying to sell, debtors, people who owe you money, and obviously the money that you actually have in the bank. You then take away the current liabilities, which will be the people you owe money to, might be an overdraft, might be some lease agreements, that sort of thing. And the current assets less the current liabilities gives you a net current asset position. If that's positive, it means that you've got short-term assets that will cover your short-term liabilities. If it's negative, it could mean you're going to have cash flow pressure if all the people you owe money to start applying pressure. Then from that, you have your long-term liabilities, which will be things like loans and maybe HB agreements and things like that. Take that away, gives you the net assets. And that's the end of the first half of the balance sheet. But a balance sheet must balance. So the other part of the balance sheet is the capital and reserves. So you have the share capital, you have the retained profits that the business has made over the period, and that gives you your capital employed. And the capital employed and the net assets should be the same, because that's what makes a balance sheet balance. And a balance sheet is a snapshot. So it's just saying, as at today, these are our assets, these are our liabilities.
And for anyone running a limited company, these are the two main financial statements that you're going to be dealing with and need to know about.
Absolutely.
And what we'll cover as we're going to go through it, we're going to just take the example of someone, an entrepreneur, selling widgets across the course of a year. And we'll also, at the end of it, as we go through the examples, how different people will look at the accounts in terms of the taxman, investors, and the people involved in the business themselves. Different people obviously look at the whole things, but different parts are more relevant for different stakeholders.
Yeah, absolutely. So the first thing that you'll do when you start your business, start your company, is you're going to issue some share capital to the founders, the owners. And there's other videos that we have out there about how many shares you should have, different types of shares. So you have a look at those if you're not sure. But the first thing you do is you issue some share capital. So we're going to have £100 worth of shares that we are going to issue. So we now have £100 in our share capital, and we have £100 in the bank. So as you can see, our balance sheet balances. We've got £100 as that filters through in net assets, and we have £100 of capital employed. So that's the first thing that you would do. So you're now going to be selling widgets. So the first thing you're then going to do from your trading is you're going to buy some widgets.
We've got some money and we're spending it.
Exactly. So let's say we're going to buy £1,000 worth of widgets. So we've now got £1,000 we owe in here as our current liabilities, £1,000, and then we have a green asset because we've then got £1,000 of stock. So as you can see, with that transaction, we've now got £1,100 worth of assets, current assets, but we've got £1,000 of current liabilities. Take one away from the other, leaves us with £100 of net assets, and we've got £100 capital employed. Our balance sheet still balances. But as you can see, we bought £1,000 of items, we've got invoices but nothing has yet affected our profit and loss account. So we're now going to sell some of those widgets. So we're going to sell 10% of those widgets, but we're going to sell those for £300. So
you're going to do some maths now.
we are going to do some math. So we've got sales of £300,
300, good start.
and we're going to have a debtor of £300, which will also be an asset. So on there. So
Make sure that's all right.
So linked to that, we've now got to, we've sold 10%. So we've got we minus £100 out of our stock, and put £100 into our cost of sales. So our stock is now 900. It's no longer 1,000 because we've moved that out of stock and we've sold £100 worth of the stock. So if we now look at our balance sheet, we start off with looking at the profit and loss account. We've had sales of £300. Those widgets cost us £100. We're going to have a net profit before tax of £200. Okay, so our retained profits at the moment, if we ignore taxation, because that's something you'd look at, probably just at an end of year adjustment. So our management accounts are showing a profit of £200, and our balance sheet will now be 900, 1,000, 1,300, less £1,000 that we still owe for the liabilities, means we have net assets of £300. Our share capital and our retained profits at £200. Our balance sheet still balances, that should be 200, sorry. Yes, we sold it for 300. It cost us 100, so we've got £200. So our net assets are £300. So you can see how the interaction between the P&L and the balance sheet has had nothing really at this point to do with movement of cash or anything like that. It's just bits of paper. We've raised a sales invoice. We've got a purchase invoice. We haven't paid for any of it yet, and balance sheet then works.
I suppose one of the questions is, am I having to worry about this as I go through in terms of, I'm an entrepreneur, I'm starting selling, how is this going on in the background? Should I have my software set up to deal with this? This is just sort of a live example of something that...
Yeah, you need to have some system that's going to capture all that information, so that you can, and yes, this would all be happening within Xero or Sage or ClearBooks or QuickBooks, whatever software you're using. But this is what it's doing in the background.
Okay.
It's the old double entry bookkeeping.
Yeah.
In as much as you see, every time we put a piece of paper in one place, there's an identical piece of paper has to go, a post-it note has to go somewhere else, so that our balance sheet continues to balance. So if we now then say, right, and in terms of should you be concerned and whatever, when you look at this, we can see that we've got £1,300 of current assets and we've got £1,000 of current liabilities. So you look at that and say, well, that's okay. If these people also pay me now, we've got things that we can turn into cash relatively quickly, is the idea. So therefore, we've got 1.3 times more current assets than we have current liabilities. However, what we don't know is how quickly, of course, we're going to turn that stock into sales. We don't know how quickly these people are going to pay. What if they became a bad debt? There's all those sorts of things. So,
and that's really the cash flow element.
Exactly, yeah. So so that's when we're saying what would people be looking at. As a snapshot on its own, that balance sheet looks okay. There's more short-term assets than there are short-term liabilities, but that's right now. If that bad debt becomes if that debtor becomes a bad debt, suddenly we'll have £100 loss, because we've given them the £100 of stock and they haven't paid us for it. So that's why the balance sheet is always a snapshot, and that can be quite difficult then for the banks or for investors and whatever. Is that the most recently filed accounts at Companies House could have been December 19, 31st December. Well, that already today is 9 months ago.
Could be a very
And with
different
what's
situation.
happened this year, the situation of the company could be so different, and that's why that is just a snapshot. And so you do have to, you want as up to date information as possible to be able to
assess the health.
assess the financial strength of the business. Yeah.
Yeah. So we're doing all right. We're doing all right just now.
We're doing all right at the moment. So what happens next is our debtor then pays. So we can move that onto the cash. So we've now got £400 of cash, £900, and actually the balance sheet hasn't really changed, and that movement of cash has had no impact at all on the profit and loss account. Our widget supplier is now saying, I need some money, and we've only got £400 in cash. So this is what sometimes they call this the acid ratio or quick ratio. We've got £400 in cash, but we've got £1,000 of short-term liabilities. So actually, is there going to be some cash flow pressure at that point? But let's assume these people have, it's all paid and we've got credit terms and everything else. And this is it. We didn't incur any overheads. We're just operating out of our bedroom. We haven't got rents and staff and all those things which would come in here. So we've got a gross profit of £200, which feeds through to a net profit of £200. We've got to the end of the year. What happens now? Well, the tax man comes along and 19% corporation tax. It's all very simple. So we've got a £38 tax liability that we owe the tax man.
Taxman's always there.
Yeah.
He's
So
always there.
So he goes in there, £38. Now there has to be another side to that entry. We now owe the taxman, so our current liabilities, we've got another £98 to go on there, £38 rather to go on there, because that's how much we owe the taxman. So that now means our profit. So if we go in there as current liabilities, our profit after tax is £162.
It's a good example of how fluid, especially if you're selling lots of widgets or products, from that perspective.
Yeah.
It's a fluid picture.
And so at this stage, we won't need to change, but our retained profits are no longer £200, because at this point, I won't change it just yet. We're now going to take off the 38. That should be 162. So we've got £262 capital employed, and if we take our assets, £1,300, less our liabilities of 1,038, our net assets are £262, our balance sheet still balances, and we can see who we owe money to, what we've got. So out of our £162, we're now going to pay we're going to pay the owners something. We're going to retain £100 and we're going to pay £62 in dividends to the founders, investors, whatever, and that leaves us with, then we put that there, and that leaves us with a retained profit. Oops.
All right.
A retained profit of £100, which then feeds into our here as well, £100 there, and that's us done. The end of the year, we sold some widgets for £300. They cost us £100. We made £200 profit. We've got a liability to the taxman in 9 months' time of £38. 162 profit after tax. We paid our shareholders £62. We've left £100 in the retained profits in the business to carry on. So the one bit the bit we just haven't done as we've been going through that, of course, is we've got £62 of dividends being paid out, but we haven't put the £62, the other side of that entry. There must be a double entry. So the £62 of cash has gone, or we owe the founders, the shareholders, £60. Just probably we've taken that out of cash. We ought to be doing that. So then when we come down, we can see that we've got £238 there plus the other 100, so we've got £338 plus our £900 of stock, less the £1,038 that we owe. We're left with net assets of £200, and that's represented by the share capital and then the profits that we've retained in the business.
So in terms of different people, look at, obviously the taxman he's after that in terms of what's that's number. Obviously, as you're starting your limited company, investment is a big thing to start. What is the investor going to be looking at? Aside from the point of a snapshot, and better investors will know that and want probably more up-to-date balance sheets. Where's the investor looking when you're looking at the balance sheet?
So for me, I think the first place that I always look is the net current assets. So you're looking at are there enough short-term assets to meet the short-term liabilities? And as we demonstrated, you then take that a level even further of how much actual cash have they got against current. And cash is king always. And so that would always be probably the first place that you would look. The next one would be, are they actually solvent at all? So businesses, particularly startup tech businesses, they're not going to make £200 on their first transaction. They'll have employed coders, they might have offices, they might have all of those things, and we, it might have been 6 months before they got their first sale, so there'd be all these overheads that have got to be covered. But the bit with that is, how have they funded that? So if they've gone out and raised share capital or share premium to cover that, so that they're still solvent. We've raised £100,000, but we spent 50,000 before we made any money. You did the right thing because you structured the business ready for that. So I think the first one would be, can you meet your immediate liabilities? Then the second thing would probably be how well structured and funded is the business to begin with, and then and that's the starting point. I haven't looked at the P&L account, and I think you find most accountants will always go to a balance sheet to assess the financial health of a business. Whereas most people, other people would think, well, the P&L is the one that's going to tell you. Whereas actually, this business, there is a risk. If this was the whole year, they've got 9 years of stock. So if I was looking at this account, they've got 9 years of stock. That's a concern. Are they going to run out of cash? So, a bit of an exaggerated example.
No, exactly. It's whereas in that cash figure is, when you're getting started, you're looking at that first, second, third, and last, because you can feel you're doing well, etc. Sales are coming, but that cash position is all important. Okay, I hope that's been helpful. Trying to take you through, as I say, the two main financial statements that you'll have as a limited company. All companies are required by law to provide shareholders with their accounting information. So one of the other aspects to this is key is your accounting records from the day you start. It's important to have systems in place and get organized, because as I say, particularly if you're in a fast moving business where sales are happening consistently, the picture can change quite quickly. So you need to be able to have your accounting systems to deal with that. I hope that's been helpful. As I say, don't forget to subscribe, where we've got other videos with various hints and tips on getting your business established and going from day one. And thanks for watching.